This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we take a look at the market trade, wrapping up the week and heading into the long holiday weekend, we welcome in Ted Seifried with Zaner Ag Hedge joining us here today. Ted, good to catch up with you, sir. How are you, man?
I'm doing well, Jesse. It's Friday. Happy Friday. 3-day weekend. Yay.
Yeah, I know, right? Well, and for me, busy 3 days at the Farm Progress Show. And as we were chatting a little bit before we went on the air, I'm worn out. I'm ready for the long holiday weekend. And, heading into Friday, it felt like maybe the markets were worn out. A lot of risk-off sentiment. And then we turned that around on Friday. Risk-on sentiment across much of the grains, energy, stock market. Kind of an up and down week, obviously, with the back and forth between risk off, risk on. General thoughts here with the market trade as we wrap up the week and head to the holiday weekend. What stands out to you with this kind of back and forth in the trade?
Yeah, general thoughts. First of all, Jesse, if you're tired after 3 days of Farm Progress, you should try Crop Tour. That's all I'm going to say. But yeah, no, risk on, risk off. Although, look, I don't feel like Friday is risk on necessarily. It's short covering after a big risk off week. Guys wanting to, in front of a 3-day weekend, sort of take some profits on the short positions that they had in crude oil, in the stock market. I guess you could say long positions in the dollar, but short positions in the bonds. The selling that we saw all over soybeans. Again, we get a little bit of a bounce. That tends to happen when you have a very one-directional week. The end of the week ends up, the last day of the week, we go the other way because, we're just taking some profits. Mm-hmm. To some extent, a little risk on, I suppose. But I mean, you look at crude oil, for example, at one point almost up $3, really having a hard time at points staying above unchanged and, kind of leveling off about $1 higher. That's not a very impressive bounce off of a very, very key support level. I don't think you can feel really very good about the risk-on aspect of these markets going into this 3-day holiday weekend. As far as grains are concerned, I think we had a fair amount of reason to be somewhat bullish for grains coming into this week. The pro farmer number with a really low corn yield estimate, and then put that together with weather forecasts for more 100-degree days in the areas that have been hit the hardest, and for soybeans, we were talking about, hey, the pods are there, but really need a good finish off to the season. Well, you look at the forecast, you're going to get the opposite of that. So this should still be a weather market for soybeans. It should be something we're getting excited about, even though we don't have our weekly export sales. We've seen some nice daily export sales come in there. But yet we were down pretty hard. And that's because there's a broader, bigger picture thing happening. If you go back to, if you remember mid-June, where really things fell apart. I mean, that's when we broke off our highs, and we haven't really ever been able to recover back to that completely. Everybody's kind of scratching their head and saying, why did that happen? You can go back and say, well, maybe weather got better, but it didn't. We're realizing right now that weather actually didn't get better. But no, that was a big risk off event, inflation off, recession on. I think this week you're seeing signs of that coming back into the market. And if that's how we finish off this calendar year, I hate to say it, but you can stop talking about corn yield. You can stop talking about weather for soybeans. You can stop talking about the daily exports, because none of those things are really going to matter. What is going to matter is the overall money flow coming out of the markets, and to make it real, right? To really give it justification. If we are going into this inflation off, recession on period of time, Jesse, then you are going to see these high prices, these historically high prices, not record high, but on the historical high end of prices. And we've been here for a long time. You're going to see these prices start to create demand destruction in a much bigger way. That's going to happen at some point. In fact, we've gone a very long time without that happening. Go back to 2012, that happened immediately because we didn't have this massive inflationary undercurrent that we have had in these markets for the last 2 years. But you take that away, and price rationing happens very quickly, both domestically and globally. And again, that's the concern that I have going into the fall and winter because I don't really watch Game of Thrones, but I know the saying, winter is coming, right? And you get that feeling just the way the stocks are acting, the way crude is acting, the way the dollar is acting, the way the bonds are acting, just the way everything is acting. You get this feeling that things are going to get a little dicey here as we get into fall and winter. And I do think that consumer demand for a lot of things is going to slow down pretty dramatically once the cooler temperatures come in, whether it be proteins, beef and pork, or gasoline. We're not going to, I feel like we are going to really slow down our driving in this fall and winter. A lot of that, by the way, because working from home or going into the office is a much more discretional thing than it had been in the past.
Yeah.
We really wanted to enjoy the summer because for a lot of us, especially the people in cities, it's the first real open summer that we've had in 2 years. So, everybody wanted to get back to normal. And we've done that. And we've spent a lot of money doing that. Fall into winter, I think, is when people say, okay, we've had our fun, we've spent our money, we need to heal up, we heal our bank accounts up, and ration our demand. And that's, again, the concern. So I can't say for sure that, everything falls apart, right? I hope it doesn't. I don't think this is a 2008 type scenario because this was artificially created by stimulus. And now that the stimulus is gone, I think we get back to sort of where we were before all that happened. We'll probably overcorrect because that's what we do, but I don't think it's a catastrophic event. And maybe not. Maybe this goes on for a little while longer. There is a global tightness for grains right now. If that demand is there, between the weather issues in China, the weather issues in South Africa, the weather issues, or the Ukraine issues, the weather issues in Europe as a whole, there's not a whole lot of grain to go around. So if the demand's there, then we can stay up at these prices for a while. But then look at the next South American crop. They've had 2 La Nina hurt crops in a row. They're going to be planting everything they can possibly plant this year. There's estimates of 150 million metric tons, 150 plus million metric tons of soybeans. That corn crop's going to be huge. The chances are that, by the time we get to the Brazilian harvest, there won't be a supply problem anymore. So I don't know if it's now or then or sometime in between now and then, but I really worry about the downside in these markets. I didn't have that feeling this time last year. I do very much have that feeling right now. I think there's a tremendous amount of risk in these markets in both directions. It could be higher, but if the higher we go in the short term, the lower we go in the long run, or it certainly could be lower. And I worry about what happens here fall into winter from an overall broader economy perspective.
Well, Ted, excuse me. Wow.
You're not the first.
I'm going to edit that out.
Okay.
Ted, I heard a lot of conversations at the Farm Progress show, just surrounding margins, surrounding the cost of inputs, fertilizer, etc. A lot of growers wondering what they should do. Should they look at, maybe they have some 22 crop that they have locked in, but they're even thinking 23. They're going, a lot of thinking that if I can lock in fertilizer seed and I can lock in a price and I know my margin, then maybe I should do that. So what are your thoughts with just to everything you said there as we look at these markets? Is it smart to start thinking about locking in not just this 22 crop more, but 23 crop as well, Ted?
Yeah, so there's a couple things to unpack there, Jesse. If you are booking inputs, it is rather important that you book the outputs too, meaning you make your sales, right? Those two things need to go lockstep if you're booking inputs. If you're not booking inputs right now and you want to roll the dice on those things coming down, which, by the way, if we do get into that global recession type thing, they will get cheaper. Very likely, I have to say. But if you're locking in inputs, then you have to take advantage of the good prices that we have for your grain. You got to do it. At the very least, you got to own puts. You got to have some sort of protection underneath, because the absolute catastrophic event would be you lock in high price inputs. You don't lock in your grain prices, and then something bad does happen. And let's say we go to 430 corn and $11 soybeans, and now all of a sudden I'm really underwater. And what does that mean for next year? Am I going to be hanging on to the rents that I have? That is a potentially, it's a potential situation which I think the likelihood of happening is a lot higher than I want it to be. But it is a potentially catastrophic situation that could pull some people out of the industry. And for the people that have a good balance sheet, the people that have prepared, i.e. the people that have sold, the board, or protected the prices that we have on the board while purchasing inputs, healthy enough balance sheet, you're going to be in a position to grow. So that could be a really good thing for some people too, but it could be very catastrophic for others, for people that aren't really managing the risk that they have by paying for these high price inputs. So you got to do both. Now, if you're not locking in your inputs, I still think there's a very good reason to be going in and looking at the November 13 beans trading 13.50. These 23 corn trading 6.12, 6.15. These aren't bad prices. I mean, it's really hard to go broke selling $6 or $13 plus, corn and beans. If you wanted to be 25 to 35% sold on new crop already, regardless of inputs, yeah, I'm really encouraging my guys to do that. But if you are buying inputs, then you have to do it. I can't be more clear about that.
Well, and there's been, I heard a lot of folks talking about it as well. A lot of folks that don't normally do a lot of that marketing into, a new crop year 23, like right now, or, looking at even, they're still waiting to maybe get it off the combine first before they make any more moves on 22 crops. So I think there's a lot of folks maybe trying to change their thinking. And I think a lot of it circles back around to the biggest worry I heard about was fertilizer. Nat gas, that's getting pummeled a little bit on Friday here. Europe prices have been coming down a little bit, but still a lot of plants shut down. I think there's just a lot of worry surrounding the fertilizer market as a whole that's really, really kind of concerning a lot of our producers, not to mention just some of the worry, especially with this 22 crop, about whether we have it or not. But that's a different discussion. I think there's just a lot of worry out there about fertilizer right now globally, Ted.
Yeah, right. And I mean, again, going back to the conversation we had, if you are really worried about it and you feel compelled to have to book things right now, fine. Lock in board prices on your grain, though. You can't risk the downside. If you're paying at or near record high prices for inputs, you can't risk the downside on grain. That is, again, the potentially catastrophic situation that you cannot afford to risk. So that being said, things always seem the most bullish at the top, and natural gas seems to be the only market that's sort of marching to its own fundamentals, which are really rather bullish at the moment, right? But I don't think over time that it's immune to an overall turndown. It has been somewhat to this point, but again, that's another really good reason to be locking in board price on grains too, because what happens if you don't? Let's say you don't book your inputs, and grain prices fall somewhat dramatically, and inputs don't, and you're penciling out and you're saying, I don't know how I'm going to make a profit this year, because I can't grow a crop that's going to make any money. So that's not quite as bad as actually planting a crop and having booked inputs that now you're wildly negative on your balance sheet. That's the absolute worst case scenario. But the second worst case scenario is that you can't afford to plant. That's not good either. We don't want to do that. So again, that's where marketing of the 23 crop comes in. I think we'll have our opportunities. I don't think this is. I don't think it's 2008 where we're just completely going to fall apart and be 330 corn all of a sudden. But you have to have your mindset on that. You really do have to be doing that. And look, I will say that I'll be rather surprised if fertilizer prices aren't better than where they are right now when we're getting into the spring. But that's all speculation. I can't say that for sure.
Definitely. Livestock this past week maybe it kind of felt like it marched a little bit to its own drum. It was kind of maybe separate somewhat from the sentiments and grains and energies, but still kind of tied to it. Any more thoughts in this protein sector? I know you mentioned a little bit when you started the show, talked about kind of the broader economic commodity picture, but any thoughts in livestock as we head into the holiday weekend?
Yeah, it's been a down couple weeks in cattle. But then look at a S&P chart and then look at a cattle chart, and you're gonna be like, oh, aha. So when you have stocks coming down like that, and we worry about our investments, our 401ks, and things like that, the mindset is always, people are going to be a little bit less spendy on the more premium cuts of protein, right? And so we worry about demand. Box beef prices have come down. We're at the lowest level that we've been in box beef since mid-May, which has allowed cash to come lower. And cash is traded at $1 to $2 lower this week. So, that's all kind of happened. We had a really nice reversal higher on Friday. The chart looks better. It looks like we went and found that support, and you had a cluster of moving averages between 140 and 142. And we were able to bounce off that starting on Thursday, but following through on Friday. Feeder cattle have been helped by the lower price of corn this week, not Friday, but the rest of the week. And actually, back to corn real quick. Corn looks like it's going to scratch out an unchanged week here, pretty close to it, while beans are down fairly sharply. So I want to be bullish cattle, but again, that comes back to the idea of what happens with the overall economy, and keep a close eye on the stock market for that. Cattle traders do. As far as hogs are concerned, I think there's an interesting play for the hogs, potentially for your speculators, your New York guys thinking, hey, if people are going to be spending less at the grocer and they don't want to pay up for the higher price cuts of meat, they're going to look for an alternative, a cheaper alternative, and pork might be a really good alternative to some people at some point. So I think hogs could get that speculative interest at some point. But in the meantime, yeah, we've broken off our highs. We're back in this range between, or at least October is between, 81 and 88. I think for now, we just kind of trade sideways until we know more about what's going to happen in the broader picture, and with feedstocks and things like that.
Well, and one other thing too, I just kind of popped into my head when you were talking about that corn cattle relationship. One has to wonder how much corn is going to have to come from the east into feedlot country here this fall and winter. That's going to be a story I think to watch as well, Ted, very closely.
That's going to be a very big basis story. Absolutely. It's not easy to get corn from the east to the west, right? Or vice versa, right? Up or down. That's really corn goes up or down, or it goes west, but it goes west from the Dakotas to the Pacific Northwest. Getting corn from Ohio to Nebraska, oh boy. So yeah, no, that's going to be an interesting thing, and that's going to be something we're talking about a lot. But I think more than anything, that's really going to play itself out in regional bases.
Very true. Ted, before we run out of time, I'll leave it to you. Floor is open. Any final thoughts you have for us today?
Yeah, like I said, this has been a week where I think we've had some reasons to want to be bullish grains, but then you see soybeans in particular go the other way in a big way. You have to be cognizant that sometimes, not always, certainly not always, but sometimes there are bigger factors than individual fundamentals to individual markets. And this week was a week that kind of showed us that maybe we might be going into a time frame of something like that. If that is the case, don't fight it. Don't say, hey, but look at the weather, but look at the corn carrier or the corn yields coming down. Okay, sure, I'm not going to argue those things, but then look at the prices of what's going on the board. You cannot argue what the board does. So just don't be married to the idea of these things have to go higher, because at the price levels that we're at right now, they don't. And that's the reality, right? So, man, you really got to be on your toes. And this is a very difficult market. The last couple of years have been relatively easy. Demand is hot, supply's not, and inflation means that we're not going to get demand destruction. So higher we go. Now things are a lot murkier, and we are at some very high prices. So they're very fragile potentially. Realize that these outside factors have a very big impact on our markets right now. And just go with what the price action tells you to do, right? And be very careful if you're booking input costs and not immediately booking on the board.
Well, Ted, if folks need some advice, I know they can reach out to you at Zaner. How is what's the best way that they could do that?
Yeah, my direct line is 312-277-0113. I pick up my phone pretty much wherever I'm at. Other than that, you can find us on the web at www.zaner.com. We've got a lot of interesting stuff that we're releasing to help with marketing tools. And then aside from that, you can find me on Twitter at the Ted Spread. I like to do handstands and crop tour, and yeah, it's sort of the lighter side of me, but yeah, it's fun.
Well, Ted, always a pleasure, sir. I appreciate you joining us here headed into the holiday weekend, and have a good one. We'll talk to you again real soon.
Yeah, thanks, Jesse. Always a pleasure. Thanks for having me on. Talk to you again soon.
Ted Seifried, Zaner Ag Heads, joining us today on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.